All right, good morning, and thank you for joining us today for the final session in our four-part series focusing on transaction service basics for business owners, hosted by the Michigan Manufacturers Association and the closely held business experts at Clayton and McCurvey. This series of virtual discussions has provided valuable resources and insights to manufacturing business owners and are considering a transaction or those who may already be in the process. This morning, we'll be looking at the back end of a deal, the considerations that should be front of mind to maximize profits and manage liquidity and maintain a strong company culture. My name is Caroline Leathan, and I am Director of Environmental and Regulatory Policy for the Michigan Manufacturers Association. MMA is the only statewide organization focused solely on securing a prosperous future for Michigan manufacturers through effective advocacy, meaningful education, and strategic business services. We represent nearly 1,700 members, ranging from small mom and pop shops to the world's largest and most iconic corporations. Facilitating today's discussion will be Jim Beal, a shareholder at Clayton and McCurvey and the firm's leader of their manufacturing and distribution. Jim has been with Clayton and McCurvey for over 25 years, providing clients with strategic solutions that generate tax savings, solve operational issues, and provide peace of mind. Before we get started, I've got a bit of housekeeping to cover. We hope that today's discussion will be interactive, so please feel free to use the Q&A function to share your thoughts and questions for Jim, Margaret, and Casey. There should be a button toward the bottom of your screen that you can click on to open the Q&A screen. If you're having any technical issues, you can enter them in the chat function, which is also found at the taskbar at the bottom of your screen. After today's session, we will be sending you a recording of today's discussion as well, as well as the slides. So watch your inbox for that within the next 24 hours. I'm looking forward to hearing what this fantastic panel of professionals has in store for us this morning. Good morning, Jim. I'll hand things off to you.
Thanks, Caroline. As Caroline mentioned, my name is Jim Beal. I am a shareholder at Clayton & McCurvey, and I head up our M&D, our manufacturing distribution group. I do want to welcome you today to the session on post-closing Now What. It is number 4 in the 4-part series, all aimed at trying to teach transaction basics to closely held manufacturing companies and management groups. So we deal with a lot of manufacturing companies that have gone through the sale process, and it appears there's a fair amount of education that has to occur with the group to make them up to speed on what's happening in a transaction. So today is number 4. We have had 3 prior sessions that we've gone through. One on May 6th, which was an overview session by Tim Hilligus, who's in our transaction group. May 20th, we did a session with a roundtable with an investment banker, a M&A attorney, and then Tim Hilligus, who does a lot of our transaction work, a facilitated discussion that talked through how the team works and interacts on a transaction. And then last session we did on June 10th, Ben Smith and Nick Lloyd from our transaction group walk through due diligence, a little bit deeper dive. So all 3 of those sessions are available on our website or the MMA website. And if you didn't get a chance to see those, by all means, go back and look at those tapes. There's some good information in there that hopefully will help you. Today's speakers, let me do the introductions. Margaret Amsden. Margaret is a shareholder at Clayton & McCurvey, where she leads our private client services practice. She's a point person for individual estate and succession planning, tax strategies, and entity structuring. She interprets tax legislation, working proactively with clients to realize the best possible advantage. Welcome, Margaret. Also, we have Casey Haggerty. Casey is a senior manager at Clayton & McCurvey and works with Margaret in the private client services practice. Casey supports clients with their tax planning strategies, including advising them on various tax aspects of trust and estate planning. Welcome, Casey. I will turn it over to Margaret, and Margaret's going to run the session from here.
Thank you, Jim. So first I have to make sure I'm running and talking and don't get confused, but we'll see how that goes. So welcome, everybody. Good morning. Thanks for joining us. Kind of some of the takeaways from today's session. When people sell their business, a lot of things can change in how their life kind of operates, or maybe nothing changes in terms of what they do every day. But we want to talk about, again, We talked about building a team to get you through the transaction. We want to talk a little bit about the team you should have around you once the transaction is done. Some of the things you should think about as you're going forward, and how all of this transaction stuff impacts things like your net worth, your estate plan, some tax advantages for potentially gifting to your kids or your family members, as well as doing some charitable giving, which can be an outcome of a large liquidation event. So we're gonna get started here with kind of how to build your team, and I'm gonna let Casey walk us through that.
Thank you, Margaret. Welcome, everybody. As Margaret mentioned, we want to jump right here and talk about building your team. So team for this purpose, we're talking about obviously post-closing, after a liquidation event, some of the things you need to consider. Who do you have to have on your team? So who's on this team? This is by no means an all-inclusive list where other members can't be part of it, but this is typically what we see, and I guess what we recommend you have on your side at this phase. So who's part of that team? So typically there's going to be an investment advisor, an estate planning attorney, as well as your accountant or your CPA. What role do each of them play on this team for this purpose? So starting with the investment advisor, what we're talking about here as a primary responsibility is development of a financial plan. So really, what do I mean by a financial plan? And keep in mind, I'm not an investment advisor, so I'm sure those of you on the call that are could articulate this much better. But the key thing that I want to drive home is that a financial plan is not just a, hey, I had a liquidation event, I got some money now, what should I invest in, right? A financial plan is a much more comprehensive thing that takes into consideration cash flow planning, as well as certain life events. How's your life going to change? So what am I talking about there? You may be accustomed to a certain lifestyle and used to certain lifestyle expenses. Maybe that's going to change after this liquidation event. Maybe you want to go build a house. Maybe you want to move. Maybe you want to travel more. Maybe you want to start paying for some family members' education, etc. A good investment advisor part of this team is going to make sure that they're developing that financial plan so that when they do consider, okay, how do we want to invest money? How do we want to deploy it? When do we want to deploy it? What do we want to have on the side? They're prepared for those various life events, okay? And they can project that out, obviously, multiple years to give you comfort that based on the way that they're going to invest your money, that you have sufficient funds to accommodate the way you want to live well into retirement. So that's the investment advisor. One thing I want to point out there is just a distinction. Investment advisor is a pretty widely used term. And when people are operating a business, one of their bigger financial assets aside from the business is usually maybe their retirement account, their 401k. And maybe that's managed by whoever administers the plan. That could be a Fidelity, that could be a Vanguard, a John Hancock, etc. All of those folks are investment advisors, or they have investment advisors at these brokerage firms. The thing I want to emphasize here is just that an investment advisor for this purpose is going to, or should be, providing a different service level than some of those other advisors that may have just solely worked with regard to retirement assets. So you want to make sure you're using somebody here who definitely lives in that world and works with high net worth individuals and is aware of the things that need to be considered. So we also have an estate planning attorney on this team. And so very similar concept that, while you may have had, just like you've had to have a different attorney that maybe handled a deal when you were going through it versus who would have handled your corporate matters, you really want to make sure the attorney you're dealing with here lives in the estate planning world. So you could definitely find attorneys that are out there that say, hey, I do a little bit of corporate work, I do a little bit of estate planning, I'm capable of drafting a trust, I'm capable of doing your will, I've done it before. The service level we're talking about, you want somebody who spends all of their time in this area. What are they going to do for you? Well, whether you have them already or not, if you have them, they may need to be modified, changed, but if you don't have them, you definitely need to get them drafted, and that's your estate documents. Those consist of your will, your trusts, your power of attorney, et cetera. Margaret's going to talk a little bit later about what exactly composes an estate plan. But they're the ones that need to draft those documents. So, your CPA may be well-versed in law that applies to estate planning. They can't draft those documents. Investment advisors, same thing. They're not going to be the ones that can draft those documents. You need an attorney who knows what they're doing in this area that can draft documents for you. One other thing I want to mention is that, the attorney's not just there to draft your documents and they're done. They also want to consider some other strategic matters. I have on here asset protection matters. I think this goes overlooked a little bit and is becoming more and more of a popular topic that comes up in these conversations. What do I mean by asset protection? I'm not necessarily talking about an income tax strategy. I'm not talking about necessarily an estate tax saving strategy, but simply different vehicles that can be used to protect your assets. And those could be anything from just having money set aside in trusts with certain terms, or utilizing LLCs to hold assets in certain ways, in certain structures, to ensure that in the event of something unexpected happening that puts your assets at risk, you have a structure in place that protects them. So that could be anything from a lawsuit to a divorce to old creditors coming after you. Asset protection could be something significant that you want to talk about with your attorney. And then last but not least, we have your accountant or your CPA rounding out this team here. What role do they play? Well, obviously they're going to be handling your tax return on an annual basis, probably have done so throughout, you running your business up until your liquidation event. Their role may change a little bit from what you used to before, depending on, how involved they were as your business was being operated. It could be a situation where you go from, you got a W-2 every single year and there was tax withheld, you never had to worry about a quarterly estimate. And now all of a sudden, most of your income is investment income. You're going to need to have somebody helping you with projections and tax planning to ensure, number one, you're meeting your obligations from an estimated tax payment perspective, but also employing whatever strategy you can use to reduce your tax liability, manage your tax rate, avoid unexpected events in that way. I also have on here just a quarterback of the overall plan. This doesn't need to be the accountant, but the reason I have it under there is because whoever is kind of leading the way is going to be somebody who has a good view of the overall big picture. And when it comes to an investment advisor, they could play that role if they're involved enough and they have a knowledge of where assets lie. But oftentimes there could be more than one investment advisor involved. You could have money at Morgan Stanley, you could have money at Merrill Lynch, and they know what they know, but they don't know what else is out there. Even an estate planning attorney, they will have a view of the big picture, but it tends to be a more static view. And what I mean by that is they got to know what's out there, what's going on in your life, your relatives, your family, your assets, et cetera, as of whenever they're drafting your documents. And, they should be obviously also involved as things change, but there is less frequent touch points for an attorney, whereas an accountant is going to be touching base with you multiple times throughout the year and is going to be able to identify situations in which it's advisable to get one of the other parties on the team involved. If something's changed in your life, if you're going through something where we're like, you know what, we need to talk to the attorney and we need to update your document for this, or this is going to change the way your advisor is going to invest your assets because of what you're changing here or what you're getting into. So oftentimes that CPA is the one that's best able to quarterback and lead that plan. All right, so kind of continued here building your team. We talked about who's on it and kind of what roles they play. Now more practically, how do we put this team together? How do we assemble this team? So Oftentimes, the best way to do this is through referrals and relationships. So you may have a really good relationship with a certain member of that team, whether that be your investment advisor, your attorney, or your CPA. If you don't have the other pieces, the first step would be to see what that one that you do have a relationship with recommends. Who would they refer you to? And hopefully they're not referring you to just, whoever comes top of mind. It really should be a discussion about who is a good fit based on personality, based on your situation, based on complexity, etc. So I encourage anybody who's building that team to seek referrals from those that they work with and those that they trust, that know their situation and what might be a good fit for them. When to assemble this team? This is a pretty easy one that most people can probably anticipate the answer, and the answer is sooner is better than later. So whether you've gone through a deal or considering going through a deal, the sooner you have this team in place, the better they're going to be able to advise you on the various things you need to be aware of or consider as you approach a deal, as you close on a deal, and after a deal is completed and your liquidation event is complete. So it's not that you can't assemble this team after a deal has occurred. You're just in a better position to do so beforehand so that they can better lend their advice. How do we want these advisors to interplay together? How do we want them to work? And this may also seem like an obvious answer, but you'd be surprised how many times this really just doesn't happen. You're going to want this team, your advisors, to be willing and able to work together rather than in silos. Okay. It's not uncommon for a certain member, whether that be the CPA who says, I just need the tax document so I can do the tax return, or an investment advisor to say, I just give me the tax return at the end of the year. I can see what it looks like and I can make my investment decisions. You don't want somebody working in a silo. You want them constantly consulting each other. Hopefully they have a relationship with each other, so that becomes a little bit more natural process. But that's also where your quarterback comes into play, who can help you kind of coordinate those things, keep things moving forward, and has that view of the big picture so they know when to involve what parties and how they are going to be able to contribute. So, we've talked a little bit about some of the benefits of really assembling the right team. But just to reemphasize, with a good team, with the right service level, you're going to have an experience level and different perspectives that are going to help you get the right answer, whatever your situation is. You're going to get that wide range of advice from multiple professionals that may have different views or different ways to do things. So given the number of people involved, whatever situation you're faced with, chances are somebody on that team has seen something similar, and they're going to be able to advise you as to how to handle it or what might be a good solution. The other thing I just want to mention, when you have the right team in place, you are far less likely to encounter what I would call surprises or unexpected results. Surprises is probably a more friendly word for it. What am I talking about when I say surprises, unexpected results? So not trying to pick on any member of the team, because it can happen in any scenario, but to give an example, investment advisors oftentimes will recommend insurance as a good option for somebody to invest in. Maybe it's to provide liquidity for a certain event. Maybe it has a specific purpose. Maybe it's an investment, honestly, because even though the individual involved has to pass away for it to pay out, maybe the payout compared to a premium is really just a good way to go. Who knows? But doing something like that without consulting with the attorney and the CPA can have some pretty bad consequences. I mean, when you're talking about insurance, you got to consider so many things. Who's going to hold it? How is it going to be titled? Is it going to be an individual's name that's going to own the policy? Is a trust going to own it? That could impact your estate or your spouse's estate. You never know, depending on how your trust may be drafted, who's the beneficiary, who's the trustee. Maybe the trust doesn't even permit the trustee to purchase life insurance with the trust funds. It all could come into play. as well as just, who's the beneficiary. Do you really want it to be whoever you just assume, or is that person in a position where them being a beneficiary is going to cause them issues? How are you going to fund premiums? I mean, that's the biggest thing that is really a planning thing. It may be very well to say, okay, I can go get this policy, I'm going to title it to this person or this trust, but you got to fund ongoing premiums a lot of times, and that could cause gift issues. So not that these things, if it's done, can't be corrected. It's just oftentimes it could be expensive and unfavorable to the client to have to go through that. Other times where, working as a team versus in silos could have an unintended effect. You think of maybe an investment advisor recommends conversions of a IRA to a Roth IRA, very common practice. It's a taxable event. And maybe an advisor says, well, you sent me your tax return last year. I know where your tax rate is. I think we can convert X number of dollars to your Roth and you should be fine. Well, maybe they're not aware that the accountant also is planning an event from a business perspective that's going to cause your tax rate to be much higher this year. If they're not working together and talking about that and consulting each other, you could end up paying more taxes than you need to. Just a couple examples, there are a ton more where you could end up in a position without having that communication, that team in place, that you pay for on the back end. So we just want to emphasize there's a lot of benefits, but also one of those benefits is avoiding these unexpected situations.
Thanks, Casey. So, so we talked about what the team is that you want to have in place, but the other thing that everybody has to consider is, what is life going to look like now that I've sold my business? And kind of the starting point there is, what did I actually sell? So some people are going to sell their business. Maybe they're going to sell to a strategic buyer, and the strategic buyer is going to buy 100% of the company, and they have a fairly short transition period. But much more common in today's marketplace is that you're selling and there's some kind of a long-term or longer-term impact with regard to selling the business. So for example, if you sell to private equity, they may be anticipating that you're going to roll over a percentage of your business, that you're going to stay involved in your business, and as a result, you are going to, keep working. You're going to continue getting a paycheck. You're going to continue being covered by their health insurance. So all of those kinds of things can impact what you're going to do on a day-to-day basis. So you really have to stop and think about, as you're building your plan, what is it going to look like to have that substantial liquidity event? And are you really going to be able to just change your life, or is your life going to continue going on where you're still an employee, you still go to work every day, you've got obligations to run the business, to help hit certain earnouts, you're still managing HR, you're still managing all of the issues around the business, and you may also still own real estate, right? So you could have real estate assets out there that you used to own at the same time you owned 100% of the business. Now you own the real estate, but the operating business, you only own, say, 20% of it or some percentage of it. So it's really important to take a step back and think through how all of those things are going to impact what your life looks like after you have done the transaction, and you've you're no longer the person that's running that business, or maybe you are still the person that's running that business. On the flip side, some people are going to sell their business and they're truly going to be retired, right? They're going to be in a position where they don't have a W-2 anymore. They're living off their investments. You have to think about a different range of issues when you're living off of your investments than when you still have a W-2 that you're getting every day and you're still an employee of a company. So, for example, we've got one client of ours who sold their business, and he's an entrepreneur. Entrepreneurs don't just stop doing stuff. They don't just retire one day. And so he was talking to some friends and he realized that there was an issue. Well, he's now out there creating this invention. And while his investment advisors started out understanding what his cash flow needs were going to be for purposes of his living expenses, he's now in a position where he's looking at getting them to completely change the investment strategy because he's trying to drive enough revenue off of his investments to create this new invention. Because the invention is a cost, it's not a revenue generator. We've got other retirees who have sold their business, they truly sold, and they've become real estate moguls. And they're out there buying real estate, which means they're not getting a W-2 anymore, but in addition to their investment portfolio, they're now generating substantial income from a real estate perspective, which is a whole different line of business that they need to learn to run in terms of how things are going to go forward. So as part of, I see owners, they're so caught up in running the business during the time they're running the business, and then they get caught up in doing the deal. At some point, you really need to force yourself to take a step back and think about what's it going to look like next? What am I going to do next? Am I really ready to retire and live off of my investments and, travel and spend time with my family? Or is there something else that I want to do? Is that next thing going to be a revenue generator? Is that next thing going to be something that I have to figure out a way to fund? Will I truly be living off my investments? And what are all those things that you need to consider? The other thing you have to think about is some of the more personal things. So, it's not unusual when it comes time for quarterly estimates. The majority of my clients, we talk to their CFO or their controller. We get an estimate of the business income. We talk to them about what that business income looks like. And then we can coordinate with the CFO to make those quarterly tax payments, right? Well, you're not necessarily going to have a CFO there anymore for purposes of making those quarterly tax payments or providing all of that information. So you're going to become the person who's responsible for all of the stuff that maybe you relied on somebody else in the organization to assist you with or take care of for you. Health insurance, right? You've been an employee for a long time. You've owned a business for a long time. Well, now if you sold your business and you've truly retired and you've cashed out, what's that insurance look like? Have you talked to your investment advisor or somebody on your team about how do you get health insurance on a going forward basis to make sure that that's taken care of? What types of administrative things have you relied on your CFO or your controller or your administrative assistant to take care of for you? Are you ready to take all those on yourself, or are you going to look at possibly outsourcing some of your personal bill pay matters and health insurance management and those kinds of things to a third party? There are some people, and I'm going to say they're, the really high net worth folks in the world, that will start what's called a family office, where they're actually going to go out and hire a team and employ those people to help them run their life. More commonly among the folks that we have in our client base is they create a family office by outsourcing all those different services. So the financial advisor they're working with handles their investment portfolio, the attorney's handling the estate plan and asset protection, the CPA's handling the tax strategy and paying the bills, and possibly also other services like, bill pay and HR and some of those things. And the team is coming together to create that family office. So you have to think about, as you're going through or getting ready for a transaction, while your life is one thing up until the date that transaction happens, there's more that changes after the transaction than just you don't own 100% of the company anymore. There's a lot of other things that are much more personal in your life that are gonna flip once that transaction happens. And that's something that you need to be prepared for and think about and talk about. And as Casey mentioned, better sooner than later. So one of the things you also want to think about is kind of, what are you worth? So as you're working with your investment advisors and your team, one of the things you have to think about is what is your worth? Have you ever done a personal balance sheet? So, as entrepreneurs, you know what a balance sheet is. You've got one for your business, but do you have one for yourself, right? And a personal balance sheet is really nothing more than what it is for a business. It's a listing of all of your assets. It's a listing of all of your liabilities. And the net of those two things is your net worth, right? And that kind of will help you understand where you're at. It can be used for creating your estate plan, because your attorney is going to do something with you that's kind of like creating a personal balance sheet in order to draft your estate plan. Your financial advisor is going to do something with you, kind of like creating a personal balance sheet, to help you create your financial plan, understand what kinds of cash flow needs you have in terms of bills that you need to pay or liabilities that you need to satisfy, as well as what assets you have that are income generating versus those that are maybe more of a drag on your income. So for example, if you create your personal balance sheet and you have a lot of personal real estate and vacation homes, those are assets that, while they may appreciate in value over time, they're more of a draw on your income as opposed to an investment portfolio, which is something that's going to generate income. And working with a personal balance sheet so that you can really think through all those moving pieces for yourself personally, will help you make sure you're prepared for your plan going forward. With regard to who prepares it, a lot of people do it yourself. So I've got a lot of clients right now where they're getting ready to go through a financing transaction, and the bank sends over a sheet and says, hey, I need you to fill this out. It's basically a personal balance sheet. It's asking for a listing of all their liabilities, asking for a listing of all their assets. They'll do that themselves. Again, your financial advisor may help you do one to do your financial plan. It's also something that your accountant can assist with in terms of creating kind of a more from an accounting standpoint. But that's something that if you don't already have one, you really want to sit down and think through what that balance sheet looks like. The biggest thing that will come out of it, and some of the things that you may want to include in it, other than just assets and liabilities, is how all those things are titled. So at some point, you need to take a step back and think through, have I transferred accounts into my trust name? Did I set anything up that's in my name but should be held jointly? That's all something that comes out of kind of creating that personal balance sheet as you're working through your investments. So we talked a little bit about what is an estate plan and the fact that you potentially already have one. Maybe you haven't revisited it in a number of years. We're in an environment right now, and I'm sure all of you have heard about the potential law changes that have been proposed by President Biden. There are various bills in the House and the Senate that are in the estate tax area. You may have done your estate plan back when you were still the owner of a business. And it may include things like buy-sell agreements that are no longer applicable. And so either as you're getting ready to do the plan, do a transaction, or after you've done a transaction is really a good time to take a step back and look at your overall estate plan. So estate plans, everybody says you should do it whenever there's a major life event coming. Marriage, divorce, birth of a child, but also significant financial events. So it's that transaction that you've just been through. You now have more assets. What do you need to potentially tweak in your plan that you maybe haven't already considered, right? Your estate plan, it's a group of documents. The last will and testament is just the base plan, says, hey, here's who I want to have my assets. But if all you have is a will, your estate is likely going to be probated. You may have a revocable trust, which is a trust that holds your assets during your lifetime. It's disregarded during your lifetime. I always like to say it's sort of the alter ego that sits on your shoulder during your life, and it doesn't really come into being until you pass away, at which point it becomes funded, and it has named in it who's the person who's going to control your assets, what's going to happen with them. But the thing that you have to think about is the irrevocable trusts. So there are a lot of different reasons to put irrevocable trusts in place. One of the things that we see most common is what's called an irrevocable life insurance trust. And a lot of times those irrevocable life insurance trusts are put in place to hold insurance where the intent was, I'm going to have that insurance to possibly fund estate taxes, because when you own your business, your biggest asset is very illiquid. So having that life insurance there to fund or provide liquidity to the estate in the event something happens is important. Well, now if you've got this irrevocable trust and you've got a life insurance policy inside of it, maybe you don't have the same liquidity needs. Maybe you don't have a buy-sell agreement that needs to be funded with it. Making sure you revisit that trust, revisit the terms of the trust, revisit the life insurance sitting inside of the trust are all things that should be looked at once you've closed out your business or sold your business or had that liquidity event that's really changed your kind of financial picture from an overall standpoint. And then always double check your powers of attorney, right? Power of attorney is something, it's a legal document that gives somebody else the ability to manage your financial and or medical affairs if you're not able to do so yourself. If you've been through a transaction, it's always important to relook at who did you name? Do you want to change any of those things? And powers of attorneys are only as good as long as you're living. Once you pass away, any power over your assets reverts to those other documents, your will, your revocable trust, your irrevocable trust. So this is an area where you really want to pull your attorney in to make sure that all of those things are in place, but you want to do it with your accountant and with your financial advisor to make sure that you've got the right assets in the right places and everything's titled correctly, and you know what's going to happen if something happens to you. So.
All right, so we also want to talk about gifting. So something that may come to mind after you've been through some sort of liquidation event is, hey, I want to make some gifts. And so this is by no means a inclusive list here, but there are a lot of different options. So who might you want to consider gifting to? Some common options are to your kids, if you have them. To your grandkids, whether they are alive or future grandkids, and even future generations, you might want to be able to provide for now that you've gone through a liquidation event, or others. I mean, it doesn't have to be restricted to family. It could be other individuals, could be neighbors, could be close friends, but Gifting is always something that comes to mind when somebody all of a sudden has a ability to do so that didn't in the past. But there are many reasons why somebody might want to go through some sort of gifting or employ some sort of gifting strategy. One of those is education. So whether it's your kids, grandkids, whoever, maybe you want to provide for their education in a way that you couldn't before. You want to set aside money and you want to make sure that you're gifting to them to be able to pay for the education that they want. Financial support is another obvious one. Whether it is your kids or somebody else, there are people that may want to be able to live a certain way, or you want them to be able to live a certain way. Things that oftentimes come up in this regard is, depending on the stage of life that you're at and whether or not that financial plan you have drawn up indicates you really need the funds you have, the question becomes, well, I know so-and-so is set to receive my, my estate when I pass, but maybe they're better off having it now. Maybe they're better off being able to use it for, just enjoying life, or even to get them out of a difficult financial situation now. And I want to make some gifts to make that happen. And then the last one I have on here is just to reduce your overall gross estate. Gifting is very oftentimes used as an estate planning strategy to reduce what you have and the estate tax that you could potentially be subject to if you were to pass. So by gifting, depending on whether or not you're going to have to use an exemption to do so, may not immediately reduce your gross estate, but depending on the amount involved, obviously that could grow. And so you could really be transferring or gifting appreciation out of your estate, future appreciation. And the main question we get is really, how should I go about gifting? Easiest and simplest way is a direct gift. Here's cash. The main benefit of doing that is control to the person receiving the gift. They can do whatever they want with it. That may be a good thing or a bad thing, depending on who you want to give to. And in a lot of times, in a lot of cases, gifting in trust ends up being a better solution. So why would I gift something in trust? Well, depending on who's receiving it, they may not be of an age or a maturity that you truly trust them with the money you want to give them. And you want it to be held in trust until they reach a certain age or accomplish something in their life before they can access those funds. And it's not always just, you don't trust them. Maybe you do trust the person you want to give the money to, but you may still want to be considering doing a gift in trust because of what we talked about earlier with regard to asset protection. That trust may provide protection from things like divorce, disability, creditors, lawsuits, etc. So you want to think that through. You just got money that you can gift, and I want to give X amount to each of my kids. Well, before you do so, consult with that team, see if it makes sense to just give them the money, or maybe do it in a little different way involving a trust. Annual exemption gifts are another way that people employ a gifting strategy. So everybody has an annual exemption that they can use every year of $15,000 per person. So each individual can give up to $15,000 to another individual in every calendar year without it affecting their lifetime exemption. Everybody has a lifetime exemption that they either use during their lifetime through gifting, or when they pass to offset their estate before it gets subject to estate taxes. As long as a gift is under an annual exemption amount, in this case right now $15,000, it doesn't impact that lifetime exemption. So in a lot of cases, people will give exactly $15,000 every year to certain individuals in an effort to continue to reduce their own estate. That $15,000 again is per person. So if you're married, you get to give $15,000 and your spouse gets to give $15,000. So maybe it's to a child. You could transfer between the two of you $30,000 in any 1 year. And if that child is married, you could transfer $30,000 to the child and $30,000 to the spouse. So we're talking about $60,000 that can effectively be transferred on an annual basis from one couple to another couple without any income or estate tax consequences of doing so. Oftentimes, again, if there's a specific goal of the gifting, they want to help them buy a house or whatever the case may be. You can split it at the end of the year, right? You could do 60,000 on December 31st, and you could do 60,000 on January 1. You're still within those annual exemption gift limits. So keep that in mind. They can also apply to gifts to trusts, given that specific terms are in that trust and certain other measures are taken. But don't shake that off as something that's just one of those things that, oh yeah, it's out there, but I don't need to use it. The sooner you come up with a strategy involving annual exemption gifts, the better use you can make of it. I know of a specific client that we have that made annual exemption gifts for years and years and years to a bunch of different relatives, and the amount of money and the amount of growth that they were able to transfer out of their estate over that period of time was just, it's pretty staggering what you can do with a lot of time and a strategy to take advantage of those annual exemption gifts. As Margaret mentioned, the Biden administration is considering a lot of changes, and one of those changes may impact this annual exemption. So we're not really sure what's going to happen there. Right now it sits at $15,000 per person per year. The last thing I have on here is just advanced gifting strategies. The only thing I really want to point out here is that no matter what type of gift you're trying to make and how you're trying to make it, there could be some more advanced strategies that you may want to employ for one reason or another, that the members of your team, whether it's your investment advisor or your CPA or your attorney, are going to be more aware of. Oftentimes those involve trusts. But you don't want to disregard it and say, okay, I know what I want to give and how I want to give it, and that's the end of the story. Have a conversation. There may be a way you can work in a strategy that helps you from an income tax perspective or an estate tax perspective, and that leaves you much better off. So charitable planning is one of the last things we want to talk about here. Again, after a liquidation event, it may be something that comes to mind that you want to give back. Maybe you already are a charitably inclined individual, and now you have the funds to do so on a much bigger scale. So when we say annual giving, that really talks about supporting those charities that you want to support on an annual basis. Maybe you give a certain amount to every charity every year. There's nothing wrong with doing that. But the thing to consider is that whether you do annual giving or accelerated giving or even some kind of a grouping of your giving, it could impact the timing and tax benefit that you ultimately get just based on the way that currently the itemized deductions and standard deduction works. Ways in which you can do accelerated giving. Well, first and foremost, I don't have it on this list here, but one thing to consider when we're talking about if you're going to do a certain amount every year, and you don't want to employ one of these strategies I'm about to talk about, you may want to consider grouping your giving in certain years. So maybe instead of doing it every year, every 2 years, every 3 years, to make better use of the way that the structure, the income tax law is structured right now with annual standard deduction versus itemized deductions. Talk to your CPA about what might be best there. But if you are wanting to employ some sort of accelerated giving strategy, some of the ways in which you can do that are through donor advised funds, private foundations, and charitable trusts. These are the ones we see most often. And of those three, I would say a donor advised fund is probably the most popular right now for a lot of different reasons. So to give you a little bit of an idea of what that is, if you haven't explored that before, a donor advised fund is really something that's managed by your investment advisor. And what it enables you to do is basically make a current charitable contribution that you can get a deduction for income tax purposes, but not necessarily have to decide how you want to deploy those funds and which charities you want to support. You get to do that over time on an annual basis, depending on the rules that the investment advisor has with respect to their donor advised fund accounts. So being the donor, you get to advise them on how you want it deployed on an annual basis. So maybe it's certain charities one year, different charities the next year. Maybe it's the same charity every year. And instead of, like I mentioned, you're getting a reduced tax benefit by doing it yourself every year, you accelerate it into a donor advised fund in year one, preferably the year of your transaction, in order to get the best benefit from a tax perspective. But you can support those charities on an ongoing basis. Things to consider, oftentimes it's public charities that you're talking about here that you can support from a donor advised fund. There may be a minimum amount that the investment advisor allows with their funds to support a given charity in a given year. So it's not like you're going to say, hey, I want to support these 100 charities at $10 each. That's going to be a little cumbersome, and they're usually going to have a limit, although it's nothing absurd like $10,000. There's going to be a number. You just have to talk to your investment advisor and make sure that whatever those rules are, they fit what your charitable planning strategy is. Another way to employ an accelerated giving strategy is through a private foundation. So we have many private foundations that our client base has and that we handle for them, or that we handle the tax obligations for. It can serve the same purpose in terms of giving you the accelerated deduction in the year of a transaction, or in a specific year that you want to have that deduction hit. The main difference between a private foundation and a donor advised fund is just the administrative burdens that come with it. So donor advised funds are extremely efficient. You're not filing a tax return. You're not really having to do a lot of ongoing maintenance. A private foundation is much more cumbersome. So with a private foundation, you're going to have to apply for tax exempt status first and foremost, which the IRS can then grant you. It could be a period of time before you actually get that. But in the meantime, there are specific rules that you have to follow with regard to your giving on an annual basis, depending on how much is in the private foundation. There's a tax return that needs to be filed every year. There's just a lot more maintenance involved and costs involved in a private foundation that you don't have in something like a donor advised fund. However, there are definitely situations where a private foundation makes a lot of sense. And one of those situations is where you're supporting a cause that maybe there's not a private or a public charity out there that's really supporting that cause right now, or not doing it sufficiently to your liking, and you really want a private foundation that's going to support that specific cause. Maybe there are grants that you want to give out for certain purposes. Maybe there's scholarships you want to grant for certain universities, etc. Private foundations are going to be better suited to be able to help you do that than donor advised funds, although you may be able to do it indirectly. Or, just simply the scale. If you're going to run a private foundation that's going to employ individuals to run it, and it's going to be something that somebody works on a daily basis, maybe a foundation makes more sense than a donor advised fund, because you can actually pay salaries to people to go ahead and run that and make those charitable decisions and keep things going and bring money in, etc. So some differences there you want to consider before you just go down one road or the other. A third option is a charitable trust. There are many forms of charitable trusts out there, some of which you get a charitable, all of them you're going to get that charitable deduction accelerated in the year you want it, but the timing at which the charity is actually supported and funded is different. So there are charitable lead trusts out there. There are charitable remainder trusts out there. There are pooled income funds out there. All of them are going to be a little different, but the main thing that most of them have in common that are different from either a private foundation or a donor advised fund is there is an income stream that you can still earn off of a charitable trust. So maybe you have a certain amount that you'd like to be able to give to charity, but you're not confident that you don't need some sort of income stream off of there. You want to explore the charitable trusts and what those might be able to do. Investment advisors are a good source to talk to about this, accountants, as well as your attorney, that may be able to take your situation and say, you know what, this is what I'm hearing. This is what this vehicle can do. Does that make sense? Administratively, they also have their own tax returns. They're a little bit more administratively burdensome than a donor advised fund, which is the simplest. But depending on the situation, all three may be beneficial. So you really want to have that conversation if you're charitably inclined as to what's the best strategy to employ.
Margaret, any other comments, Margaret?
No, I think I saw one question did come up and you answered that. Thanks, Jim. I think that's really what we wanted to cover. And it's just, remembering that you've been running a business for, potentially 30, 40 years, and, you're now in a different mode. And unfortunately, it probably hasn't gotten easier. And there may be a whole different landscape of things that you need to learn now. And it's important to put your team together to make sure that it's all going to be managed.
And besides the shock to the business owner, as an advisor to that manufacturing or distribution company, I have a skill set. I have a tool set to attack addressing that illiquid business, that asset, when I go out on an annual basis or on a quarterly basis. So I've got a number of clients that I've worked with over 20 years. They go into a transaction, they become liquid. There's a different skill set that's required when you get into the liquid from the advisor standpoint. So I always pull in Margaret and Casey because they bring a different toolbox to the party. I stay involved. I am involved in the oversight, but there's a different team that needs to be built when you become liquid. And if you build the right team, the advantages can be significant. And a few items that you just pick up in the process that at least I've seen live in action have addressed significant tax savings as well as comfort level with the business owner. So I think that's a key when you're looking at these transactions. So if there's no other questions that are out there, I guess I'll turn it over to Caroline to wrap up.
Thank you so much. So first of all, I'd like to thank our panelists today, Jim Beal, Margaret Amsden, and Casey Haggerty. Thank you for all of the insights you've shared today. To our participants, we encourage you to reach out to any one of us with your thoughts, questions, or just to chat and brainstorm. Both Clayton and McCurvey and MMA have a vast array of resources available to support Michigan manufacturers. So be sure to check out our websites at claytonmccurvey.com and mimfg.org. Once again, thanks everyone and have a great day.